global stock and bond markets have been dealing with macro and geopolitical issues including inflation, rising oil prices, and a pivoting Federal Reserve. Global equity markets are in correction or bear market territory, and fixed income markets have not been spared as the Federal Reserve began raising interest rates with a 25 basis point increase on March 16th, the first increase since 2018. So far, the biggest impacts of the Russian invasion of Ukraine are related to oil prices, inflation, and the path forward for global monetary policy. The overarching worry for many investors is if these factors will tip Europe, the US, or the world into an economic recession. Oil prices have spiked to levels last seen in 2008. The increase follows a significant decline during the initial months of the COVID-19 crisis. The resurgence in oil prices was well underway prior to the Russian invasion. But Russia is a major oil producer, and the sanctions being imposed by the rest of the world will affect global oil supply in the future. The sharp rise in oil prices will likely result in a slowdown of economic activity, but in and of itself does not necessarily precipitate a recession. Other factors, including the Federal Reserve tightening cycle, will come into play. After starting to decline in late 2021, inflation expectations spiked at the start of the year. At the end of March, inflation expectations are at the highest levels since the early 1980s. Some of this surge is likely due to the war in Ukraine and the related increases in energy and commodity costs. As you can see from the chart, short-term inflation expectations are higher than longer-term expectations. The short-term concerns about higher levels of inflation are fueled by monetary policy in the US and abroad. Global central banks have started raising interest rates. The US Federal Reserve took its first step of this tightening cycle in mid-March, raising rates by 25 basis points to a range of 0.25% to 0.5%. The 2-year US Treasury yield recently rose to 2.38%, breaking 2% for the first time since 2019. The 2-year bond has historically been a good leading indicator of the Fed's fund rate, but has a tendency to overshoot. Fighting inflation in the short term could mean hiking rates faster and higher than the market is currently anticipating. In the US, there are concerns about the Federal Reserve's ability to use Fed fund rate increases to combat the higher levels of inflation without putting pressure on the markets. Geopolitical events affect market performance in different magnitudes, or as investors grapple with the toll of the events and their effect on the global economy. Often, other extraneous factors outside of the conflict itself will impact market performance over the next 12 months. For example, in 2008, Russia invaded Georgia in the midst of the Great Financial Crisis, which was already affecting markets around the world. For this current conflict, the rising levels of inflation and interest rates, which were already at play before the invasion, are likely to continue to be a primary focus in coming months. There is no way of knowing the ultimate outcome of the ongoing conflict in Ukraine or its effect on the global economy and financial markets. History suggests that the trajectory of the economy prior to the event will continue, but markets do not respond well to uncertainty, and volatility will continue to be an ever-present reality of markets in the coming months. We are optimistic that markets will stabilize, but investors should stick to long-term asset allocation targets with a focus on high-quality investments.